All right. We're going to talk here with Ann and Patrick. Ann and Patrick, you're with Allworth Money Matters.
Hi, Scott and Pat. Thanks for taking our call.
Yes. Nice to have two of you. This is good.
Yeah.
Your opening remarks is actually a perfect segue into our question.
Oh, good.
So the volatility of the market has us both pretty freaked out. We're both retired, have been for some time. My husband is going on 72. I just turned 70. And so recently, my husband has said to me that he would like to basically go all in to cash.
Well,
and
in the money market, or
money market.
Yes, and
with
how long have you been retired? How many years?
Well, our first retirement was in 2005. And then the financial crisis hit when we both went back to work. And then recently re-retired in the end of 2013.
Okay.
So you you first retired at 50 and 52.
Correct.
Relatively.
That's young.
And do you have pensions?
No.
Okay.
Okay.
We've been riding this wave of the stock market for good 20 years now.
And how did you guys navigate through the financial crisis? Like, what were some of the investment decisions you made as the markets were going crazy then?
We didn't do a good job of that one, of 2008.
Yeah,
And
tell us about it.
We lost 50% of our portfolio in that crisis. And since then, we learned that we needed to have more cash available to ride out these waves. And that's what we've done for this one. But my feeling is that this is going to be a long downturn, that even if our leaders decide something different, it's going to take a while to build that trust back with these other countries, and that it's going to be a long, slow growth back. So, and I expect that it's going to get far worse before it gets better.
So let me ask a question. So back in 2008,
that's exactly where I was going to go to.
Okay, Scott, go.
No, go ahead.
Oh, back in 2008, you said you lost 50% of the portfolio. At one point in time, the portfolio, if you were 100% equities, was down by about 50%. What did you do at that point in time? How did you react?
So we were actually professionally managed during that.
Okay.
And we basically the professional management managed the portfolio through much of that process. Again, whatever buy and sell processes, it was done by professional managers.
Okay.
And it was, I believe in 2009 was when we basically stopped doing the professional management. We did not.
You went to cash?
Sorry.
Did you go to cash?
No, we went very slowly into cash. It wasn't like we sold off a bunch.
You went to cash.
Cash.
Ultimately, you went to cash, though.
We went to again. It was about a 4 to 5 year. How much we would need to be able to last 4 to 5 years in cash.
Okay.
And then the rest we kept. And so where we're at currently, I can give you the number.
Fire away.
And by the way, if you tell me today you're 100% stock and you're relying on your portfolio, we would say you need to sell some of your stocks today to have enough cushion. Okay.
Right.
So tell us the account balances and how much income you're taking from them.
Okay. So in my IRA, I have 1.2. And then I have a Roth of 380. My husband is pretty much the same, 1.2 in the IRA and 380 in the Roth. The breakdown is about 63 to 64% in stock, 23% in bonds, and about 13% in cash.
Okay.
We pull out about 110 per year, and that's before taxes. We are
So
currently
it's a little less than
Social Security.
little less than 4% of your portfolio.
Yeah.
Correct. Yeah. We collect Social Security of about 5.4K per month. I have a very, very small pension, and my husband has an inherited IRA, and that combined is about $1,000 per month.
How much time is left on the inherited IRA?
The interesting thing is, the thing that's different for me is, in 2008, I had the ability to go back to work.
That's right.
So did my wife.
That's right.
So did Ann. Now we're looking in our 70s. That's going to be a lot harder.
All right. Well, let's
right. And we went back to work, by the way, in 2008. So she went. She got it. We both got jobs and worked for 5 years.
Well, if early 50s is pretty young to retire. So let's think about this, right? Because it's not an all or nothing, Patrick. It's not an all or nothing. It doesn't mean, hey, either we're in or we're out, right? So right now you're at about 65%, and you've got 60% equities, and the rest is bonds and cash.
You've got about a decade to go before you with your withdrawals, and that's even if you increase your withdrawals for inflation before you have to start selling any stocks. 10 years.
You've got a long, long time. So this is part of being a financial advisor. Scott and I have done this for a long, long time. Is managing emotion. That is probably the most difficult part of the portfolio. Is not actually the portfolio itself. It's the client attached to the portfolio. Did that come out wrong?
No.
Behavioral finance. It's it.
So if you were my client, Patrick, I'd acquiesce a little bit. I'd give up 10% of the portfolio in equities just to keep you grounded in the rest, to make you feel good. Because the problem is you want to feel like you're doing something. No one wants to sit in a burning building and think, why am I sitting in this burning building?
Right. That's what it feels like.
I draw the analogy as to, I think we ordered a Lyft to come to our house and pick us up. And what showed up is an Uber, and the driver's drunk.
Okay.
And we can't get out of the car.
Yeah. So right. That's how you feel.
That's how it feels.
Right. And actually, when we started this conversation, Patrick used the word "feel" twice.
Mm-hmm.
He said, "I feel like this time I can't go back to work."
Well, it's real.
Right. Well, you could. You just don't need to. You don't want to. But by the way, you don't have to. Like if you took every word we said as gospel, Scott and I would say you're fine. Right? You're fine. Because you are.
You are.
But you don't feel that way.
No, we don't feel that way.
So let's give it a little.
And up until like even 2 weeks ago, I was still of the opinion of, we just need to, we've got cash that can get us through the next 4 to 5 years, so we should be okay. But I tell you, it is just so every day feels like something has blown up.
I hear it from.
And I don't want to come out of this in 4 to 5 years with half my portfolio.
I hear it in your voice. I hear it in your voice, right? I hear it in your voice. If you want, you could go all to cash, right? We could put you in a high yield short-term treasury, and you get
just under 4%.
Yes, and you won't grow, but you won't shrink either, other than by your distributions and distribution.
And that's exactly what I suggested to my wife. Because I said, I know we can get 4%.
But what happens
off of 4%? We would come out no worse than where we are right now.
It's a terrible idea.
We can live on that.
What's that?
It's a terrible idea.
Okay. Okay, convince us why.
Well, your cost of living 10, 15, 20 years from now is going to be much higher than it is today.
But at 90, we're not going to be, spending like we have, right? We won't be doing trips and
Maybe, maybe
honestly,
not.
We won't.
I have clients in their late 80s that
Still travel
a lot.
Yeah. It's
a lot, right?
Depending on health. Then you
Yes,
can have.
that's what-
We are.
Yeah, I certainly hope we are.
We are.
Yeah.
We enjoy that.
So where we're at right now, you said you're approximately 60% equities.
And I added your cash and your bonds together because that's not tied to the stock market. You can sell bonds to help produce your income. You've got a decade plus there. And like the most important thing is to have a portfolio that you guys will live with through this turmoil. Because it might be done in 3 weeks. It might be done in 3 years.
That's the
you
problem.
really think in 3 weeks it would be any better?
Oh, could be.
serious.
Oh, it wouldn't,
I don't think-
it wouldn't surprise me at all if it was better in 3 weeks.
In what way, though? I see that's the part I'm
what
struggling
happens?
with,
Oh,
because we have done so much damage with our trading partners and
no,
everything else. that
they trade. They trade.
Very much symbiotic relationships
Look,
here.
they trade. We call them, in our industry, we compete with Fidelity and Charles Schwab. We use Fidelity and Charles Schwab, right? They're frenemies. They're friends one day, they're enemies the next. They're frenemies. They don't want us to take clients from them. We don't want them to take clients from us, but we
You're
all
saying it's
do
the same thing
business
with these-
together. And it's the same with trading partners. So it won't take much, right? It will not take much if Vietnam comes back and says, okay, this is the deal we cut.
Look, the reality is
or this the deal we
nobody
cut.
knows what's going to happen in the future.
But it could be 3 weeks. It could be 3 years.
We might have already hit the lows in the stock market. I don't know.
Yeah. But
Yeah.
we're talking about you and your portfolio. Right?
Yeah. So back to Pat, you had said something about maybe to help create more of a buffer that creates again that feeling of, well, one, we've done something, and two, it gives us a little bit more of a cushion of feeling of safety. You talked about maybe
that's right.
10%.
That's right.
10%. Give up 10% equities, moving into bonds. You're not going to crush yourself, right? You're not going to crush
Or money
yourself.
markets, you put it in cash, whatever you feel most comfortable with.
Or,
Buy treasuries, CDs, whatever.
But you're not going to crush yourself by that. But you going all out of the market at this point in time, you're going to crush yourself over the long term.
And I'm picturing clients right now that went to cash in March of 2009, about a week before the bottom of the stock market, literally 1 week prior.
Yeah.
And I picture them in my mind. They were retired. Their life never came back because the markets recovered. They didn't really quite get back in. It changed the dynamic. And you might look at it and say, well, we have over $3 million saved. Like, what do we need to worry about the markets? But if you already have a decade's worth of spending outside of the stock market, if you want, put a little bit more there. But the statistical chance of the market being lower 10 years from now than today is so minor. And there are some risks we can't escape. Let's assume, if this system of government that we have completely falls apart and the dollar becomes worthless, there's not a lot you're going to be able to do. It's all about political connections at that point.
Right.
Right.
Well, that's cheery, Scott.
I'm just saying, right? We live in this system, right? We have to.
That's right.
No, the reality. People talk, well, what if I have gold or like? No, you need
What
to be
about
highly.
gold?
Like,
Yeah.
you need to be highly
We're not
connected.
interested in-
You need to be highly connected politically. If we have some
Right.
complete
We're not
change.
interested in going into gold or that sort of thing.
Thank you.
Again, like I said, if it was like one of those ultimate.
But
risk
gold,
things,
you can't eat
We
gold.
should be buying guns and butter, right?
Thank you.
Not-
Thank you.
And hire a militia.
Militia. But so give up 10%. Give up 10%. Make yourself feel like you did something. Any more than that, you're doing some long-term damage to yourself. And even then, I would try to convince you not to give up the 10%. The problem is, look, the psychological problem is I've kept clients in markets long past the time that they wanted to be.
That's right. So a month from now it might be worse, and you think that son of a Hanson and McLean.
They don't know what they're
bunch of
talking
idiots.
about. And then the clients go out completely. So that's why, psychologically, we're a little bit more apt to give up a little early on because
You need to live through this.
You need to live. You
Yeah.
feel hopeless, right?
Yeah, the primary difference, and I think that Patrick was talking about it, was that at least, we lived through the dot bomb first, in 2000. We lived through the financial crisis. But in those two instances, I always felt like we had people within positions of authority
Okay.
that had the complete responsibility for what's happening. And I felt like they were working towards trying to find a solution.
Okay. So here's what I just heard.
I don't feel like that now.
Yeah. Here's
What's
what I
that?
just heard is you're not a MAGA fan.
Well, from your position. So my take on things is I think the government does more damage than they do good by and large when it comes to the marketplace.
Okay.
I really do. I am a free marketer to my core. And I believe the beautiful thing about the capital markets is it is truth and like money flows to where the companies that provide the goods and services that people want. And when companies are making money, it's
when the government gets in there, look at all that money that was given to Intel for the CHIPS Act, right? You're just like, what the heck?
So
who would give any money to Intel?
And the financial crisis, I believe, was created because of the government backing all these crappy loans.
That lack of regulation.
Exactly.
Yes.
So I've never had a lot of
I
faith in our
agree.
government.
So
I absolutely agree with that. But I truly felt as though that, when things started getting pretty bad, that there was an effort to try to make things better.
Yeah.
And again, it has nothing to do with the other stuff, red, blue, whatever.
I get what you're saying. I get what you're saying. That's
Right.
the view of the world.
But here's the reality right here. So this is primarily one individual that's pushing the tariffs, right? Trump. I mean, let's call it what it is.
Right.
And most business leaders are not happy about this. There's already been some cracks within his base, right? So he doesn't have unlimited power. I know that some people think but he really doesn't. We've got Congress that can act. We have the Supreme Court that we can act. We have an impeachment. There's lots of things that the checks and balances in place. So he's burning a lot of political capital right now.
That's true.
He is burning a lot of political capital. And if the Dow continues to slide and the S&P continues to slide,
he'll fold.
Eventually, he's not going to have any friends left. Mar-a-Lago is going to be empty.
So, all right, just make that little minor change in the portfolio and hang in there.
All right.
All right, take care.
We really appreciate.
All right.
Thank
And
you
we
so
don't know,
much.
by the way, we have no idea what's going to happen in the future any more than you do. But if you look over history,
I
if you go
understand,
back,
but you certainly have, you're not as emotionally tied to this. Although I'm sure you're getting lots of phone calls from clients.
Actually, I gotta. People keep asking me that. So I've been doing this for a long time. My newest client has been with me for 15 years, right?
well,
so
yeah.
they're not,
yeah,
right? We've been through the dance multiple times.
this is part of it.
This is it.
This is part of it. It really is. This is how we get the average of stocks historically have done 7 percentage points above that of the rate of inflation since 1925. 7 percentage points above the rate of inflation.
Why, Scott?
Yeah.
Why?
Risk. The risk.
Yeah, otherwise they would have been bid up to the point where
Yeah, the yields were low. Anyway, appreciate the call.
yeah.